Welcome to the Political Risk Podcast, where risk, insurance, and geopolitics mix. I'm your host, David Benyon, and welcome to this special episode produced in association with Verisk Maplecroft. My two guests are Jimena Blanco, Chief Analyst at Maplecroft, and Hugo Brennan, Maplecroft's Research Director for Europe, the Middle East and Africa. In this special episode, we'll discuss the political risk outlook for 2025, published by Maplecroft late last year. Maplecroft is the global risk unit of insurance heavyweight Verisk. And the political risk outlook draws on Verisk Maplecroft's unique portfolio of country risk data, alongside analysis from its team of experts to strip back the complexity of some of the key global issues that are driving the risk environment for international business. The research is designed to help companies and investors understand where and how geopolitical and political risks are emerging and what they mean for them. This is a forward-looking and insightful conversation because Jimena and Hugo are so engaged with working with clients from a range of sectors, looking ahead to drive geopolitical risk strategies and find ways to reduce the effect of the turbulence that we can all see across the international system. To highlight just how on the nose this conversation is, a few brief notes about ongoing events. We recorded in late January just before some relevant events took place, such as the Democratic Republic of Congo, where the Rwanda-backed M23 rebels went on the offensive, taking at least two major towns, Goma and Bukavu, illustrating the conflict corridor across sub-Saharan Africa, which we go on to talk about. Obviously, when it comes to tariffs, that picture is still forming as well, with the tariffs threatened by the Trump administration on Mexican and Canadian imports into the US paused, but certainly not gone away yet. And also the sheer pace of news with regard to the US, Russia, and talks about Ukraine in recent days. Almost daily rhetoric suggested negotiating points, but again, nothing concrete yet in terms of outcomes, peace talks, or anything agreed between the parties. But again, it illustrates the pace at which geopolitical events are taking place. Okay, that's enough from me. Let's get into the conversation. Jimena, Hugo, welcome to the pod. Thanks for joining me.
Thank you for having us.
Yeah, great to be with you.
So the Verisk Maplecroft Political Risk Outlook is a really meaty analysis of the geopolitical forces that are in flux around the globe as we start the new year. So Jimena, to start with, would you provide us with an introduction to the report itself, the scope, the purpose, and really how it fits into the context of Maplecroft's broader activities?
Our political risk outlook is really setting out the stage. And as you said, we're entering a new year in which the world has really become less predictable. We're seeing that traditional alliances are shifting. We're seeing that pre-existing, but also new geopolitical battlegrounds are emerging and the existing ones are intensifying. So really what the report does is it looks at our data to set the scene for the year. And what our data is showing is that the international system is heating up. And so businesses are entering 2025 with a new risk baseline. And then we use the same data that we first analyzed to set the context to go into a deeper dive into some of the key issues that we identify. So it's really important to keep in mind that when we're doing this, while we look at specific issues and we go deeper into them, it's not just one factor that's driving this new risk baseline. It's really a bit of a perfect storm because we are seeing political risk intensify across the globe, but we also see issues like civil unrest, like conflict, like challenges to government authority, trade disputes, the use of sanctions, etc. All of these issues, in some cases, are converging and making the situation worse for business. In other cases, they remain distinct risk issues for companies, for investors, for insurers to handle. But also, I think it's really important to say, because these risks are very widespread geographically, chances are that anyone who's listening to the podcast anywhere on the globe is potentially exposed to them, right? The degree to which they're exposed or the way in which they may affect a particular industry or a specific location will differ based on exactly where you are in the world. But I don't think, we will have a listener who would say, I'm removed from all of these issues. So I think from that perspective, the political risk outlook is particularly important because it sets a picture of how risks are interconnected and how they may impact stakeholders across a variety of industries and jurisdictions.
So the report warns that geopolitics continues to be the defining feature shaping the global risk landscape for business. And it also says that the cost of doing business is at a 10-year high as geopolitics takes that toll on global trade. So the question for both of you, it's obviously very early days in 2025, but are we seeing some of the signals to watch that the report talks about already being played out in some of the events and the headlines in recent days?
Well, certainly. I mean, when we think about trade as this geopolitical battleground, it's not a new trend in the sense that we have been seeing this intensify since 2018. But of course, as President Trump has just taken office, then the role of international trade in this geopolitical competition is clearly intensifying. And we have seen it with policy announcements or announcements of potential future policies. If we think about the examples of Canada and Mexico, which could be facing tariffs, it's something that is really impacting not only rivals of the United States, but also allies of the United States. And, I mentioned that particular example, but we have seen this discussion on tariffs and how different countries could be impacted expand beyond those examples and also affect European countries who are also US allies.
The report emphasises the geopolitical battleground of international trade will likely intensify in the next 4 years. So far, it's been surprising that it's been directed at traditional allies as much as adversaries. Were you expecting it to unfold in quite this way?
It is unfolding to a certain degree in the way we expected because many of these measures are intended to reduce the US trade deficit with particular nations. Now, that's impacting not only rivals, but also allies, as you were mentioning. And the second part is the use of tariffs is also a bargaining tool and a negotiating tool. So when we think about, the way it's deployed against rivals, it tends to be much more directed to trying to solve imbalances in the trade relationship. So if we think about mentions of increasing tariffs further on Chinese products, etc., that is clearly part of that strategy. Now, if we think about allies like the cases of Canada or Mexico, the announcement was made, but there was time given as well. The USMCA, which is the free trade agreement between all three of these countries, would actually make a blanket tariff illegal, right? So this agreement is set up for review, and that review is due by July 2026. But right now, it's looking like this could trigger a full renegotiation of that agreement. And Mexico is already starting to talk about what areas it could start working on with greater attention. So, for example, migration, counter narcotics, as areas where results in Mexico could translate into better trade terms with the United States and the renegotiation of USMCA. And for Mexico, this is crucial because over 80% of exports now go to the United States, and it has become the United States' main trading partner. So clearly, an imposition of a 25% blanket tariff could have dire economic impacts south of the border, and that's what President Sheinbaum is trying to avoid.
China is actually a really interesting example there, because on the campaign trail, Donald Trump was mooting the prospect of imposing a 60% tariff on all Chinese imports into the US, and that's on top of the tranches of tariffs that he imposed on Chinese imports in his first term that largely the Biden administration left in place. But actually what you've seen in the days since his inauguration is that slightly softer line where President Trump has mooted a lower 10% on Chinese imports and then tied such discussions to things like fentanyl trade and the future of TikTok. So The glass half full there would be there's some sort of deal to be done, but plenty could still go wrong. The Trump administration is full of China hawks.
Hugo, just to extend on that point, sticking with trade and tariffs, which countries do you think are most vulnerable, or aside from the ones already mentioned, and could be in the sights of the new administration? I'm just kind of curious as well, like what makes a country particularly vulnerable? What are the criteria that you think you'd look for?
It's a great question. I think global leaders the world over are trying to figure that out. I mean, Jimena's mentioned Mexico and Canada, so they've been both part of Trump's early rhetoric, China as well, but also the EU. And I think some commonalities are countries that run large trade surpluses with the US are one kind of basket of potential targets for the Trump administration. Another would be those countries that are seen as a way for China to sidestep tariffs. So that would be countries like Mexico or Vietnam potentially that have benefited from the sort of supply chain dislocation caused by the first trade war, the US-China trade war under the first Trump administration. So yeah, I think Mexico, Canada, China, the EU, and then potentially Vietnam as well would be up on our list.
So for multinationals, for those headquartered or listed in the US or around the globe, what are some of the strategic options for them, and how have they tended to respond previously to these kind of pressures being brought to bear?
I think there's been a process of adaptation in the corporate world in terms of understanding their geopolitical exposure and their exposure to several of these trends, how they're evolving over time, and what actions they can undertake to become more resilient to shifts in the operating landscape. So I think it's important to understand that no one can be isolated or immune to some of the impacts. It's more about understanding the degree of exposure in different areas of your operations, whether it's within your supply chain, whether it's the exposure of your asset directly, and then also trying to see whether there are ways to mitigate the potential impact. And so companies are really looking to focus on resilience, the resilience of their own supply chains, in some cases by diversifying how they source products or inputs into their operations. Other times, it's by divesting from particular assets or particular areas. And companies are also trying to understand how in the future they may be able to prepare themselves to better withstand some of these shocks. So I think it's a two-part answer. One of it has to do with the picture of today, but then it has to do with preparing for what's coming further down the line and understanding how policies may have a cascading impact. So one of the areas we looked at in the political risk outlook has to do with how deglobalization or geoeconomic fragmentation is impacting Western democracies. And in many cases, when we look at the policies that are having a direct negative impact on Western democracies, these were policies that were originally deployed to try to reduce dependence on rivals, namely on China. And in fact, they have had quite a negative impact in terms of increasing the cost of doing business across a number of jurisdictions, including the United States, the United Kingdom, Germany, France. So businesses are starting to really look at the big picture to try to understand how it impacts closer to home in their operations.
To echo that, I think there are a few different strategies that multinational businesses are adapting to navigate this much less benign geopolitical environment we're talking about. Jimena's touched on a few there. I think first and foremost, we're definitely seeing firms investing more in understanding geopolitical dynamics. That might be by building out in-house teams or by subscribing to the services of firms such as Maplecroft. We've also seen some large multinational firms split their corporate structure, for example, into distinct Western and Eastern divisions to help better navigate those dynamics. Another strategy we've seen is companies aligning their business activities with the strategic priorities of their home governments. I think you can see this in the critical mineral space particularly. And then as Jimena said, you're seeing sort of reshoring, friendshoring, stockpiling of strategic components and raw materials, and just generally a bit more supply chain diversification with an eye on building out resilience.
I'm just keeping in mind one of the headline messages of the report, which is the cost of doing business. Because if you have to line up multiple suppliers, then obviously that's duplication. And if you've got to segment your company off into separate subsidiaries because of geopolitics, so you have an Asian business that's compartmentalized from an America's business, for example, that has massive consequences for the ability to move capital around, for example. It seems to me that's part of this cost of doing business piece, right?
Yes, I mean, if you want to think of it as an engine and you remove the oil in the engine, there's a lot more friction. So the system continues to operate, the international trade system, but it's a lot more difficult to operate and there's greater challenges. And as you were mentioning, in some cases, for companies, they also need to deal with new risks that they may have not been familiar with by having to enter new countries or by having to source from new countries or find new suppliers of particular inputs. So all of this, it does create more friction. We wish we had a crystal ball. I often compare this to when you're building a new intersection on a road. While you're building the intersection, there will be disruption. That is guaranteed. The question that we don't have an answer for is whether 10 years down the line, that means the flow of traffic, if you will be smoother, or whether the intersection will continue to create more friction even in a decade's time. So I think that is the challenge that business is facing today. They know there is disruption in the present. The question is whether the current disruption will provide a smoother system in the future or not.
Let's turn to the ultimate form of friction and disruption, and that's conflict. The report mentions that interstate tensions and conflict set the stage for a more challenging business environment across emerging as well as developed economies. And for this one, I'm aware that you both have different regional focuses. So Jimena, if you maybe provide more of an Americas view, Hugo, I know you have a particular focus on looking eastwards towards Asia and Africa, and perhaps you both provide perspectives on European markets too. The report emphasizes that conflict zones have grown by 2/3 globally since 2021 to cover 6 million square kilometers. What did the data suggest for the conflict outlook for 2025? And are there some territories across the globe that concern you both most?
I think the headline takeaway from our conflict intensity index, the data set that underpins this chapter of our PRO, is that global business leaders should be closely tracking conflict dynamics and considering how armed conflict may impact their operations and supply chains. If we start with cause for optimism before we go on to concerns, I think there is some cause for optimism in the Middle East. We've had ceasefire in Lebanon that's just been extended, and more recently in Gaza. The Houthis in Yemen have suspended their campaign against non-Israeli shipping in the Red Sea, still saying they're going to target Israeli shipping, but have said they'll pause on the campaign that's gone on for more than a year in solidarity with the war in the Gaza Strip. So that's the kind of glass half full for the Middle East. I think the cause for concern there is that the underlying Israel-Iran confrontation is still very far from resolved, and we have a Trump administration that is likely to lend strong support to the Israeli state. So, Iran's strategy of having a series of regional proxies in Lebanon, in Hezbollah, in the Gaza Strip, in Hamas, and then in Yemen by the Houthis and indeed militias. That forward defense has been shown to be a paper tiger. So the danger is that Tehran feels for its own national defense, it needs to have a new plan. And one option would be to move towards developing nuclear weapons. And that is very much a red line for the Israelis and most likely the Trump administration as well. So that's a big cause for concern. So that's in the Middle East. If we shift to Europe, again, cautious optimism that we might see an end to the Russia-Ukraine war in 2025. And I think we should call it the Russia-Ukraine war, not the war in Ukraine, because, of course, there is fighting in Russia now in the Kursk region. It's perhaps more likely we see an end to the fighting in 2025 with President Trump in office. But also it could sow the seeds if, for example, President Zelensky is kind of strong-armed into accepting a deal that is favorable to Russia. That could sow the seeds of future conflict if Moscow feels emboldened to resort to military force against its near neighbors in the future. Again, the consensus view that Trump will likely usher in an end to the war, but there is an alternative, a plausible alternative scenario whereby Trump tries to negotiate a deal or oversee a deal that fails, and actually that leads to an increase in tensions in that conflict. Maybe the Trump admission, he's quite a mercurial foreign policy president, so we could see, for example, he tries to do a deal with President Putin of Russia, it falls apart, he therefore perhaps increases support to Ukraine. So I think there are a range of plausible futures out there that businesses should be anticipating. And sure, the consensus is the war could well end, but it's far from a done deal. One other area we flagged in this chapter, the conflict chapter of our political risk outlook of concern, is in sub-Saharan Africa and this conflict corridor that we see across the Sahelian and Eastern Africa. This has seen the largest expansion in territory of the regions that we looked at as part of this chapter. So sub-Saharan Africa has seen the largest increase. There's a little sign of an end to this long-running Islamist insurgency in Mali, Burkina Faso, and Niger. Nigeria is experiencing several complex overlapping security challenges. There's a civil war in Sudan that continues to rage. Signs that Ethiopia could yet tip back into civil war. So plenty of cause concern, I think, when we look towards that conflict corridor in sub-Saharan Africa.
And maybe if I can just add a bit of a silver lining, when it comes to the Americas, the region is an outlier in the sense that it has a lot lower exposure to conflict. There is an exception within that, which is Colombia, and that is where we have seen also the intensity of conflict increase, in particular in border areas, both on the border with Ecuador and with Venezuela. But in the case of Ecuador, it has spilled over into an increase in organized crime in the country. And that has taken Ecuador from being one of the countries, especially in South America, that had a lower homicide rate per 100,000 population just 5 years ago, to being the country with the highest homicide rate in Latin America on the back of that spillover. So again, overall, the region is a lot less exposed to conflict than the cases that Hugo has discussed, but there is particular concern around Colombia and how that conflict can continue fueling violence and crime in other countries in Latin America.
Now that we're discussing Latin America, it seems like the right moment perhaps to discuss the Civil Unrest Index. That's another great data insight that's referenced within the political risk outlook.
When we look at civil unrest, of course, we're looking at a major potential source of operational disruption for companies. And it's interesting in the context of course, in 2024, we had a super election cycle and we had elections across most democracies in the globe. But these happened in a context where electorates were quite divided and frustrated with political leaders. And so there's always this risk of that frustration spilling over onto the streets. And when we look at our civil unrest index, it actually predicts that the risk of widespread protests will affect twice as many countries as those where we will see the risk recede in 2025. So from a company perspective, it's trying to understand where in the world your operations may be most exposed to these potential, spread of unrest, how it may impact your supply chains, your direct assets, or even your personnel. And as we're seeing a lot of these new governments take office on the back of the elections in 2024, or governments are quite new, we have quite a tall order for them in terms of the expectation of the populations that put them in office versus the amount of time that those populations are willing to give them to deliver results. So it's actually quite an interesting combination of electorates giving a chance to new administrations, but also not giving too much time to those administrations to deliver results. And that's where we can see civil unrest and frustration over unmet economic expectations in particular turn into a direct risk for companies operating on the ground in those jurisdictions.
A key question for businesses will be whether a lot of the new and incumbent governments, whether they can maintain a stable operating environment. So on the Civil Unrest Index, just curious, you already referred to it, but what the data tell us and how might organizations use that data to respond?
Well, first of all, what the data looks at is what are some of the drivers and underlying factors that tend to result in unrest. And so, of course, the cost of living crisis, while we have seen inflation recede around the globe, the fact that purchasing powers are still trying to catch up is a cause for concern, especially for new governments, right? So it tends to be a combination of factors. You often get, when you think about a pressure cooker, right? We have the pressure inside the cooker. What we don't know is what will be the spark that sets out a population to protest. And when those protests may turn from peaceful large demonstrations into large anti-government demonstrations that may also disrupt business operations. Often what we see is companies preparing for the knock-on impact. So for example, when those protests may start disrupting operations on roads or in ports, for example, when you may have protracted days of disruption in major urban centers that may impede a company from having its employees come into their offices, etc. And we have seen, of course, that historically civil unrest tended to be an issue associated with emerging markets, whether you were talking about Latin America or countries in Asia. But since the onset of the pandemic and in the aftermath, given the scale of inflation in developed economies, we have also seen Europe emerge as a region where civil unrest had major implications for companies. And so really what companies can do with the data is map their own operations and supply chains against where we see civil unrest at higher risk of occurring and understanding what parts of their own business may be more exposed to disruption if an event of unrest occurs.
To follow Jimena's comments there, you already mentioned the conflict corridor in sub-Saharan Africa, where we've seen so many coups in recent years, as well as all the elections in the past year. And it seems to me that's the part of the world where the issue of civil unrest, very easily spills over into out-and-out conflict. So how much has that conflict corridor grown? What's the outlook? And could you name certain countries that you think are among the shakier governments?
Happily. So I think firstly, when we talk about this conflict corridor, we should be clear. It's not one conflict. It's made up of multiple conflicts. So the civil war in Sudan is distinct from the Islamist insurgency being waged in Mali, for example. But its expansion is linked to common drivers that we see across the countries that make up this conflict corridor: weak governance, low socio-economic development. And there's certainly a link between the growth of Africa's conflict corridor and the recent resurgence in military coups that we've seen in Africa. So 5 of the 7 sub-Saharan African countries that experienced coups since January 2020 were in this conflict corridor. And indeed, many of these military governments remain under pressure amid widespread insecurity. And just to finish the question there, in terms of what sort of expansion we've seen, where we've seen a doubling in the size of this conflict corridor in Africa since January 2021. So a really significant uptick there.
Leafing through the report, I think it's fair to say that supply chain risk is a leitmotif throughout the paper. A question, again, for both of you. How and where are supply chains being imperiled by the forces of geopolitics?
So I think a really clear-cut example is the Houthi campaign against Western shipping in the Red Sea. So cargo traffic through the Suez Canal fell by 50% in 2024 shipping firms rerouted cargoes generally from Asia to Europe via the much longer and more expensive Cape of Good Hope route. This was to avoid the campaign that the Houthi rebels based in Yemen were waging against Western shipping in solidarity with their allies in the Gaza Strip. And we saw, as a result of this, shipping costs increased by fivefold on some routes. And these costs were passed on to consumers and contributed to sticky inflation in the West. And indeed, ships that continued to transit the Suez Canal faced higher war risk premiums, and in some cases were required to pay illegal transit fees, to a report by a recent UN panel of experts to the Houthi rebels. And again, these costs were all passed on to the consumers. So I think that's a really tangible example of how geopolitics has been impacting global supply chains.
I think it's really important to remember that, maybe 5 years ago, if you asked anyone on the street about supply chains, nobody would have thought much more than talking about logistics. Now, since the onset of the pandemic, the Russia-Ukraine war, conflict in the Middle East, we've all become very much aware of how these disruptions can impact the cost of living, the availability of products on the shelves of stores, and how supply chains are very complex. So we're not just talking about the times to transport things, for example, or the paperwork that accompanies trade, but we are talking about, very complex systems that we now are very much aware how they can impact day-to-day life, from, the availability of a particular fruit all the way to high-tech products that we require for the economy of the future.
Another question for both of you about how businesses can insulate their operations and their supply chains from all of this friction that's taking place throughout the system. There are some phrases that come up again and again here: friendshoring, just in time versus just in case. Is that what we're talking about here when boardrooms discuss how to insulate themselves from supply chain risk?
Businesses are trying to look for, how to diversify their supply chain to be able to do a bit of both, right? So if you think about examples we mentioned earlier in terms of Mexico and the role it now plays as a US trading partner, a lot of that has to do with the reduction in travel times, for example, versus when you're sourcing from Asia. And so that allows companies to still stick to the just in time rather than just in case. Whereas in other areas of the supply chain, companies are very much looking into the, just in case, which again, it increases some of the operating costs, and it also reduces the availability of capital to invest in other areas of the business when a company has to increase their stock. There is no way really to isolate oneself from these geopolitical trends, but it's more about rebalancing how a business operates and finding the way that it still makes it most cost effective while maintaining the speediness response and being able to diversify supply chains to be able to deliver to customers on time and in a cost-effective way.
We've certainly seen an uptick in multinational businesses seeking to build greater resilience within the global supply chains. This might be reshoring some production to the company's home country, friendshoring some production to a jurisdiction that is geopolitically well disposed to a firm's home country, or at least perceived to be. That might be developing strategic stockpiles of raw materials, components that are perceived to be at risk of disruption. This might be diversifying supply chains. A very common one is a China plus one strategy, where some production is shifted out of China to, say, a Southeast Asian country to mitigate the disruption risks, make sure not all your eggs are in one basket. Typically, businesses are cherry picking these or using a range of these techniques to try and reduce their exposure.
It's interesting to see some of the same strategies in response being used for multiple geopolitical headwinds. We already talked about the same responses earlier in terms of protectionism, but also in a supply chain context.
Yeah, I think so. I think whether it's you seeking to reduce the exposure of your operations, your assets, the geopolitical risks, or indeed your investments, or if it's more a supply chain exposure that you're looking to reduce, many of the same techniques are used. We kind of discussed them. But yeah, it is interesting.
Jimena, you co-wrote a chapter in the report about spiking protectionism and governments moving to secure supply chains for a race for critical minerals in particular. Why is this happening and how is it manifesting itself?
Well, I mean, I think the question of why is it happening is quite interesting in terms of it's really about security and what we've been talking about in terms of security of supply chains. But in particular, it's about securing the supply chain of the inputs that we need for key areas of the economy, whether we're talking about, the tech revolution, whether we're talking about the energy transition, or directly related to defense in the more traditional understanding of it and the inputs that go into defense systems. So we still see forms of protectionism and intervention happening in more traditional ways in some countries. And that's when we're thinking about resource nationalism in the form of expropriations or nationalizations. But we are also seeing a much more nuanced deployment of interventionism and protectionism, particularly in Western democracies, in this process to secure critical supply chains. And so, for example, we have seen it in European countries, and we've also seen it in North America and its allies. And this is quite an interesting trend for companies in this sphere to have to navigate, or companies who depend in the inputs that come from mining, because they're having to navigate these two trends, the more traditional form of resource nationalism that in some ways they're more used to, and then also the more nuanced new form of protectionism that developed economies are pursuing.
Yeah, and I think a key trigger for this was Russia's invasion of Ukraine, where you really had particularly European governments realizing how exposed they were or how reliant they were on Russian natural gas exports. And what that triggered is a big rethink in Western capitals around, we don't want to sleepwalk into a similar dependency on our hostile or potentially hostile state for our critical minerals, the fuel of the future. So that's why you've seen a lot of this rising protectionism and things like the Inflation Reduction Act in the US and the European Green Deal in the EU to try and make sure that Western governments don't become dependent in the way that they were on Russian gas in the build-up to Russia's full-scale invasion of Ukraine.
Jimena, what are some of the risks, but also perhaps some opportunities for multinationals that are doing business across affected jurisdictions as governments seek to secure supply chains?
Well, of course, there are challenges, and we talked a bit about those, but one of the opportunities is that there will be incentives in place, particularly those deployed by Western countries, to try to help companies or to incentivize them to invest, develop partnerships, and secure supply chains either closer to home or in allied countries. Now, the challenge for companies could come if they are operating in areas that are not deemed to be aligned with the West, or with partners who come from rival nations. So, some companies may face challenges in terms of rebalancing their portfolio of operations, but others will clearly see incentives stemming from subsidies or new partnerships between their home government and allied nations, where they could benefit from having a more streamlined relationship in which they can make the most of these opportunities. So there is no one answer fits all, but I think it's about being able to understand how the geopolitical landscape is progressing and evolving, and how that may impact these incentives, or the carrots, or how it may impact the sticks.
There are opportunities for those businesses that invest in understanding geopolitical dynamics and can be agile. I think, again, a really tangible example would be, whilst Russian gas exporters, the big stain token companies who exported gas to Europe, with the big losers from Russia's full-scale invasion and then the sanctions that the West put in place and the desire to reduce Europe's dependence on Russian gas. They were the losers. The winners were US LNG exporters who saw a big uptick in demand for their cargoes as an alternative source of gas. So there are winners and losers from shifting dynamics.
That's all for now from this special episode, produced in association with Verisk Maplecroft. I've been your host, David Benyon, and I'd like to thank my guests, Jimena Blanco and Hugo Brennan. Tune in next time, and there'll be 3 new episodes in March to look forward to. And clearly all the signs suggest that 2025 will not leave us short of geopolitical risk topics to discuss. Production was by Peter McGill and Lawrence Durkin made the music.